Good morning, Mr. and Mrs. Kessler. How are you both doing today? Oh, good. I'm so glad to hear that. How are Robert and Eileen? Oh, they're doing all right? Okay, perfect. Have you spent much time with the grandkids this year? Oh, okay. That's wonderful. Great. Well, thank you again for taking the time to fill out our questionnaire. It's super helpful for us to just get a big picture of your financial situation, and then we can go from there and break it down, whether it be through risk management, estate planning, investment planning. We've really created this full comprehensive plan for you and just, an initial review that we can continue to work through and modify as time goes on. So feel free to stop me at any point in time if you have any questions. And we'll go ahead and just start with just restating what those initial goals that we discussed last time and that you let us know were your main priority. So the first one was to reduce any estate and gift tax liability and ensure that all estate planning documents are in order. From there, you were interested in reviewing insurance coverage and discussing the implications of purchasing a long term care policy. We then looked at ways in which we could reduce your personal income taxes. And then, based on your risk tolerance level and some of the previous discussions that we've had, we've really put together a fully diversified portfolio that is, designed to meet your retirement needs and expectations. And so the last time we spoke, we, noted that you guys were, in general, you had an above average willingness to take on risk. When we look at risk tolerance, we're looking at time horizons, how comfortable you are with different volatilities, and then just looking at what phase of life you're in. You've been in the accumulation phase for quite some time now, and congratulations on both of you for your retirement. It's a super exciting time, but that also now means that you're in the spending phase of your life cycle. So, this is where we can, start to have some fun and look at ways in which we can really put your money to work, whether it's through legacy planning, charitable giving. We'll go through all of those different scenarios with you. So I just also wanted to start out and share just some basic economic assumptions that we're working with. We are assuming that you are at the highest marginal tax bracket based off of the information that we have, with no anticipated changes going forward. We are also expecting inflation to stay around 2.75% or just under 3%. Of course, the economic environment can shift, but that's the current working number that we are using, with the risk-free rate being 3% and the market risk premium being 8%. Those last two numbers aren't necessarily as important for you to understand, but it's really helpful in us to decide how your investments are doing, to just get a better look at what rate we should be getting in return for some of these different investment decisions. So we just wanted to start out big picture summary of your financial health. So currently you have a net worth of just over 13 million and a net disposable income of 1.6 million. Does that still sound about right to you too? Okay. Wonderful. So you do have a sizable net worth and, adequate income. Just in general, you're in a great financial position. We did do some basic financial calculations. When it comes to the debt to income ratio, we do look at that as a measure of, anything below one, above one. Right now, your ratio is 29. And then this means that for every $1 of debt that you have $29 in assets. And so this very strong liquidity position, but it also means that you do have some excess cash and cash equivalents. And so outside of your emergency fund, we really could see this as a weakness, just in the sense that, we want to look at it from an opportunity cost standpoint of what this cash could be doing. And so we'll dive deeper into that and some different recommendations that we have so far. But that's just general financial stance. You're doing very well. And then when we're looking at your homes and the properties so far, your principal residence has a fair market value of 900,000 and it's owned outright with no remaining mortgage, while the vacation home right now has a fair market value of 750,000 with a remaining mortgage of just over 42,000. And so with that mortgage rate being fixed at 4.75%, and the mortgage being just over 3 years remaining, we definitely could look at paying off that mortgage early if we want with some of this extra cash if we, wanted to avoid continuing to have those recurring payments. But at 4.5%, that's not a bad interest rate. And really, you don't have too much time remaining on that mortgage. So we can talk, a few different avenues through as well, but we'll get into that later. So just in general, you have a strong cash position, and I know that we did talk about potentially having the liquidity need of buying a new car. So, with interest rates being fairly high right now, paying for the car outright would help to avoid any unnecessary debt payments and, might make things simpler on your end. So, with that stronger cash position, you should have no problem paying for the car when the time is right. So, that's just something we wanted to get out there right from the start. And then the rest of the meeting really will break it down. We'll go through risk management, investment planning, retirement planning, tax planning, and then we'll break it down from there and look at estate planning at the end. And then from there, we'll provide you with some actionable items. But please don't hesitate to stop me along the way if you do have any questions. If you want me to break down any of these concepts even further, I'd be happy to dive deeper into any one of them. And also know that this is going to be a lot of information right up front. And so we will provide this plan to you so you don't have to, remember any of the numbers right now. Of course, you can take notes, and we've provided copies of this plan if you want to jot down in the margin or, save questions for later. Happy to do that as well. And then, of course, after this meeting, if any questions should come up, definitely don't hesitate to reach out. We'd be happy to go through any one of these different areas of financial planning with you even further. Perfect. Okay, any questions right off the bat? Okay, great. Perfect. Well, we'll just go ahead and start out with risk management. And so, what we're doing here is we're really looking at your insurance coverage. And so, we're looking from a homeowner standpoint, auto, health insurance. I know that were interested in purchasing a long-term care policy. And so, we'll take a look at what that would look like as well. But this is really where we just want to take a broad picture look. You do have a broad range of insurance coverages. We have identified several gaps that could expose you to unnecessary liability and out of pocket risk, but nothing that can't be taken care of fairly quickly. And so, um, just in general, we did notice that there is a lack of an umbrella liability coverage and then also potentially inadequate dwelling limits for your homeowner's insurance. We also noted that if you do intend to buy, the new car, your current automobile liability protection isn't quite up to what we would hope it would be for a vehicle, a newer or, more higher value vehicle. So those are just a few different things. And then just in general, we'll break down our recommendations first for the homeowner's policy. The policy that you have on the vacation home is perfectly fine so far. It's really the primary residence that we are more concerned about right now. Now, typically, we want to provide coverage for at least 80% of the estimated replacement cost of 775. And so we're getting that number by taking the fair market value of the house, subtracting the value of the land, the cost basis of the land, and for your primary residence, that's 620,000 worth of protection. And your current policy only provides 400,000 of coverage. And so if we are looking at a, hypothetical $100,000 loss, you're looking at a shortfall of approximately $36,000. And so, while you do have a strong cash position as is, and I'm not too worried about it on that standpoint, this is something that we would want to up the coverage for, just in case there is, a bit higher of a loss or a more severe situation. So this is an easy one where we can just up the coverage to the necessary amounts to where you wouldn't have to worry about your primary residence. Second, we wanted to just say in general, when we're looking at owning multiple residencies, multiple vehicles, significant investment assets, Really, the absence of an umbrella liability policy could represent a meaningful gap in coverage. And so, for your situation, we would recommend considering an umbrella policy anywhere to 2 to 5 million. And of course, you'll want to coordinate with your insurance agent on that. But this umbrella policy really does provide just an extra layer of coverage should anything happen. And there may be some gaps. So, that was just our second recommendation there, too. Now, with your Medicare, I know you currently both have Medicare's Parts A, B, and D in place. Has anything changed on that front? Okay. Okay, so we just noticed that there's no Medicare supplement or Medigap policy, otherwise known as Medicare Part C. If you did want to, just provide some extra coverage, it, could help reduce your exposure to co-insurance, deductibles, any uncertainty around out-of-pocket maximums. The Medigap policies are a great way to increase coverage there. And so in general, that's just one other area that when it does come time for enrollment, the next time around, you could look at enrolling in a Medigap or Medicare Advantage plan. But just in general, we'll want to be mindful of any changes to Medicare or the Affordable Care Act as we move forward. I know we just had a change in our governing body, and so as things change on the tax side, we also just want to be mindful of any changes to the Affordable Care Act as well. And I briefly mentioned, but your auto policy right now has a damage liability limit of 15,000. And so if we're looking at potentially buying a $40,000 new car, this is, quite a bit lower than what we would want. And so the current $15,000 limit would be insufficient in the event of an accident. So, a quick and easy way to just ensure that we're covering all bases would be to increase that auto liability limit to help also reduce potential lawsuit exposure going forward. And then we also broke it down. You'll receive another document with a bit more of the numeric data side of things and of our evaluation. But we do recommend considering a comprehensive long-term care insurance policy for both of you. Now, the proposed shared benefit policy would provide coverage for up to 3 years or a maximum benefit of $630,000. If implemented, a significant portion of those premiums may be deductible as a medical expense should you decide to itemize your income taxes. And, I'll break it down a little bit further when it comes to the tax planning side of things, but it does look like this could be a great year for you to itemize if you're not already doing so. And of course, you'll want to work with your accountant, but we'll dive a little bit deeper into that going forward. Any questions on the insurance risk management side of things? I know it's a lot and it's not always fun to have to work with insurance agencies and trying to get policies in place, but this is typically one area where people don't have as much coverage as they should. And, it really only takes one big bad event for, this to be a huge financial hit. And so we always want to make sure that we are overinsured versus being underinsured on all different fronts, especially if you're in as strong as a financial position as you are. Okay, no questions? All right, perfect. Well, then we will go ahead and jump into the investment planning side of things. So, we also provided an investment policy statement and a general analysis of your current investment portfolio. This is also attached to the plan, so feel free to take a look at that as I'm working through the numbers, but I'll really address this big picture. So, just in general, your current investment situation does have some weaknesses to be addressed. But when we're looking at it, we see that you have just over 3.8 million in non-qualified assets and then 1.6 million in qualified assets. In general, neither are generally well diversified. So that's, one of our largest concerns. And we do have some underperforming assets within our non-qualified portfolio as well. Now, we took a look at your portfolio to look at the amount of risk that we're given or, that we're assuming versus the expected return. And so your portfolio does have a beta of 1.04%, which means that the portfolio is expected to be a bit more volatile than the overall market given this level of risk. We did note that the portfolio as is expected to earn approximately 8.2% or 8.25% annually over the long term. But there is a bit more aggressive of an allocation than what we would expect. And so we don't have as much bonds in your portfolio as a couple that we would generally expect at your age. And I know that you've expressed, in generally speaking, a higher risk tolerance. But the heavy equity exposure does increase the downside risks and could result in a greater portfolio volatility during market downturns. And really, the way that we want to look at market downturns, it's not if, but when, but also a very healthy part of any market cycle. And so it shouldn't necessarily be seen as a bad thing, but with your current asset allocation mix, you would expect to see a bit more volatility than the general market would. So this, while maybe not an issue right now, and you might only have the liquidity need of the car at the moment, but should any other short or long-term needs arise, this, higher equity exposure could, become a problem going forward. So, a few different recommendations that we have to improve the investment position or accomplish our goals in general. First, now that you're both retired, we would recommend consolidating your 401k and 403b accounts into professionally managed rollover IRA accounts. This consolidation would allow for a more cohesive portfolio management. It would also allow us to improve the asset allocation oversight. And, as we're talking about what might be a good mix for you, this is where we could have more control over that versus just, a target date fund or whatever's available currently at your retirement planned custodians. This could also help us reduce the overall operating expenses, just depending on the fee structure of your existing plans and what funds are available. Now, this is something that we would definitely want to take another look at. So, if you're able to provide the plan documents for us, we're happy to see where we stand in terms of fees, what options are available to us from an investment management standpoint, and then also what a rollover might look like. But this consolidation would help us put everything under one roof and have a bit more control over the assets. Second, I know we just talked about having a bit higher of a risk tolerance than most couples at your age. And in your case, we still can shift a little bit more heavy equity based given such a strong financial position, but we may want to bring that closer to a 70-30 mix where we're looking at 70% equity, 30% fixed income. And so this allocation, as I said, may be more appropriate for preserving the portfolio value while also still supporting that long-term growth. And just another reminder, this is something that will be reviewed periodically as your goals and circumstances change. So even if we decide after today or after our next meeting to move towards a 70-30, we can always shift the asset allocation or portfolio mix as we need to meet your different goals. Some couples rely on their portfolios a bit more from an income standpoint, and that's where we could use this portfolio and turn on more of the fixed income levers at our disposal. But some people just use it mostly for growth or, generational wealth building. And so we're happy to shift our priorities and our expectations as we need to. We would also, in general, recommend further diversifying your portfolio. The stock portfolio is currently concentrated in only 4 individual securities with a total cost basis of $960,000 and a fair market value of $940,000. And so what this means is that we do have some opportunities for tax loss harvesting. And if you're not familiar with that concept, really, it's a great tool at our disposal. And sometimes when people look at down years in a market, they ask us, oh, are we scared? Or, is there something that we should be doing right now? Harvesting losses is a huge part of our job behind the scenes. And where we can provide some of the biggest value to you. Because as we have losses in a portfolio, if they're long or short term, both have their benefits to them. But if we harvest long term losses, which means that they've been held in your portfolio for more than a year, then we can actually use those losses to offset future gains. And so you do have a handful of stocks that have performed fairly well and that you do have an unrealized gain there. And so if we were to, potentially, we can look at stock A, for example, in your portfolio. It has a fair market value right now of $7,000 and a cost basis of $225,000. So we can use those losses, harvest those. And what we mean by that is we, sell the security and we realize those losses. And then those can move forward and stay with us indefinitely until those are used up. And so we can help offset some of the gains in your other positions to just in general improve the overall tax efficiency of your portfolio and reduce income taxes that you might need to pay, which I know is a big goal for you guys as well. Next, we do, fortunately and unfortunately, you are in the highest marginal tax bracket. And so we do recommend, right now you have about $600,000 in CDs in a savings account. And so one strategy that we could use to reduce your income taxes is we could instead put those funds to work with municipal bonds. And so the way that that works is we could find municipal bonds that are, we could do state tax free, federally tax free. Some are both, but depending on your state, they may not be available. We'll want to take another look at what we could do for your specific position. That being said, we can always do federally tax free bonds that right now we're seeing have a higher tax equivalent yield while also providing federally tax free income. And so this is a great tool at our disposal. And rather than just generating income from your CDs, now we're able to generate tax free income of the same equivalent. We would also, in general, recommend gradually transitioning your mutual fund holdings towards a portfolio that's mostly composed of low cost, tax efficient ETFs. And so, while mutual funds have been, a staple of most investment portfolios for the last 100 years or so, moving forward, there is a way in which we can, incorporate what are called these ETFs or exchange traded funds, and they track indexes at a much lower cost. They also help us reduce any capital gain distributions and improve tax efficiency. And then, as I mentioned, just in general, the lower operating expenses can provide a really big value as for most of these positions, we're just trying to track their indexes. We don't necessarily need active management. And, we're wanting to just in some senses be average in the sense where we don't necessarily need to outperform the market, but by tracking our indexes, it's a great way to, build wealth over the long term and also reduce our expenses in the process. Now, given your expressed desire to avoid the tobacco investments, one strategy that we often incorporate with our clients are looking at ESG focused funds. And so these typically exclude both tobacco and weapons manufacturers in general. And when I say ESG, I'm referring to environmental, social, and governance funds. Our firm does specialize in ESG investments, and so I'm happy to further discuss those strategies with you. But this does allow us to look at a particular investment from an environmental and social standpoint, screen out certain investments, be active shareholders, and vote proxies, and really put your dollar to work in that way. And it also would help us to just automatically exclude tobacco from your investments. And so if that's something that you're interested in, I'm happy to further discuss that with you. But of course, it's not a strategy for everyone. So, happy to further discuss it or leave things as is with the exclusion of tobacco stocks in general. Okay, any questions on those so far? Okay, definitely. If you do accept these investment planning recommendations after this meeting, we will develop and implement an asset allocation strategy specifically designed to help improve the diversification, which was one of our first issues that we brought up, enhance the tax efficiency, and then also just maximize long term return, which is, of course, the goal of the portfolio already. And then if we do also decide to move in that direction, we can give you a plan for transitioning the portfolio gradually to a more age appropriate allocation that could help protect the asset but remain consistent with your moderately high risk tolerance. Great. Okay, so next we will jump into retirement planning, and the investment side of things really feeds into this next subject. So definitely let me know if you have any questions on either as we move forward. We did conduct a retirement plan analysis for both of you and have attached that document as well. But just in general, you're well positioned for retirement with substantial assets, sufficient liquidity, and in general, with the sale of your business, John, you guys are in a very strong position where we still have income, coming in, and then we also have, sufficient assets to support our income needs going forward. However, we did want to point out that, through thoughtful coordination of investment growth, withdrawal timing, and tax strategies, this is going to be very important going forward as we are looking to preserve after tax wealth and minimize unnecessary tax exposure. So, some recommendations that we have after our preliminary analysis of the projected value of John's 401k over the next 3 years, we looked at what a guaranteed 3% CD rate, and we ignored any required minimum distributions to get an account value that was 1.05 million to approximately 1.15 million. So, given that you're already maintaining a strong cash position and had significant assets allocated already to CDs, instead, we would recommend diversifying this account across multiple market sectors and targeting a long term growth rate closer to 6%. At this 6% annual rate, the projected value of the account is approximately 1.25 million after those 3 years. And so it may not seem like much, but given your financial position and your ability to take on a bit more risk, having this retirement account in a bit, more aggressive of an allocation, even at just that expected 6% range, yields an extra $100,000 over 3 years. And so if you're willing to put up with the market volatility, which doesn't seem to be a problem so far, and you don't have any, immediate income needs, which we're, currently satisfying with your installment loan, this would be a great way for us to continue to let this account be more long-term focused rather than shifting it from that high blended, large cap equity down to, more of a CD. So that's one perspective on that. We also wanted to review just general IRA contribution eligibility for both of you. And while you can both contribute up to $8,000 this year towards your traditional IRA, and next year that will be $8,600 with the catch-up contributions for those over 50. These contributions would not be tax deductible due to the income limitations. And so, given this constraint, we do think that allocating these funds to a taxable investment account may be more advantageous, as we're really able to manage the long-term capital gains exposure. And as we mentioned before, that potential use of tax loss harvesting strategies, this is where we're really able to, use more tools at our disposal versus contributing to an IRA account and having these funds come out at your ordinary income tax rate. We can instead get that down to the long-term capital gains rate. So that's just in general our basis and basic recommendation for the IRA contributions. I know you were also both interested in potentially doing a Roth conversion for a part of your retirement assets. However, because of the installment loan payments, and this being a significant source of taxable income over the next 7 years, it may be better to defer any Roth conversions until after income levels decline. Another thing to consider with these Roth conversions is that we really want to make sure that there's enough time for something like this to pay off. if, say, you're converting $100,000, you will be paying ordinary income taxes at that point for you at the federal bracket. That could be $28,000 trimmed right off the top. And then you're assuming that there needs to be enough time for us to make back that $28,000 and then continue having the assets grow tax free. And so at your age, we wouldn't typically recommend a Roth conversion unless we're strictly looking at this from a wealth management standpoint and from a generational wealth standpoint. The Roths can be really great tools if we're looking to have assets be generate or passed down to heirs tax free, where the heirs don't have to pay taxes on these Roth accounts either. But that being said, there's the 5-year lockup period, and then any amount converted would be added to your ordinary income for the year. So there are, pros and cons to this strategy, and we're happy to talk them through further. But generally speaking, we wouldn't necessarily recommend doing this as you are already in the highest income brackets. Now, finally, we did conduct a comprehensive review of Mary's mother's account. And again, I'm so sorry for your loss, Mary. And we just wanted to give you a full picture of what the tax implications of withdrawals would be and just a basic understanding of what would be required for this account. So while the account needs to be fully distributed within 10 years, each $50,000 withdrawal would consist of approximately $5,000 return of your mom's basis and then $45,000 taxed as ordinary income. So depending on your income levels, and I know we're, at the highest brackets, another potential strategy could be to delay the larger withdrawals until after the installment loan has been fully paid out. This would reduce the likelihood of additional income taxes being, or, additional income being taxed at the highest marginal tax bracket. But of course, you will need to withdraw from this account and continue with the required minimum distributions as your mother was doing before the account had passed. And before we move on, I just want to confirm, have you been able to speak with the estate planning coordinator or attorney who's handling your mother's estate? Um, no? Okay. Well, one thing we just want to make sure is that that required minimum distribution is taken before the assets are brought over to us. This is just an easy way for us to take care of that RMD, and then the following year, then we'll look at the RMD. But of course, different strategies for this inherited IRA that we're happy to talk through different options with you as well. Now, do we have any further questions? Okay, nope. And I'm happy to talk with the estate planning attorney with you, and then we can also look at what this might look like in transitioning your mother's account over. Perfect. Okay. Next, we wanted to just look at income tax planning. And I know this was a big one in terms of your general goals and what we were looking to accomplish in terms of minimizing your estate taxes and your gifting taxes. And so we did provide tax calculations for the installment loan and machinery sale. And then this, in addition to a hypothetical sale of the inverted Jenny stamp, is also provided in the supplementary documents as well. So feel free to take those home, review, and let us know if you do have any questions. Now, so just general tax review, here's a few things that we picked up on. So based on the 800,000 installment loan down payment, we calculated that 180,000 will be treated as a return of basis, with the remaining 620,000 taxed as realized long-term capital gains. Sorry, it's a mouthful. Going forward, each installment payment of 47,517 net of interest and return of basis will generate approximately $23,394 of long-term capital gains. So that's just a number that we want to have in mind as we're looking at our income for the year and what will be a return of basis versus taxable long-term gains. Now, we also just ran a general simulation. So, assuming that you sold your piece of machinery for $35,000 to this unrelated third party and that the asset is treated as non passive, we used the original cost basis of $100,000 and the depreciation amount that you gave us of $87,610 to calculate that you will have Section 1245 realized gain of 22,610. Now, this amount will be classified as depreciation recapture and is going to be taxed at your ordinary income tax rates. So there's not much we can do at that, from that front, but we do just want to make sure that you're aware of the income taxes that would be due on this. Now, hypothetically speaking, if we did sell the inverted Jenny stamp in 10 years, we looked at a value of 2.6 million, assuming a 15% sales commission and continued exposure for you both at the highest marginal tax bracket. And we estimated that your federal tax liability will be $387,800. Now, this is calculated based on the net sale proceeds after commission and adjusted cost basis. So, this is just something that we want to keep in mind when and if you do sell this Jenny stamp. There will be a fairly hefty tax liability with it. Of course, there are ways in which we can retitle the stamp to continue to stay in the family, and we can talk about that later, but there's just a general big picture estimate if you did want to sell that stamp, what that would look like. And then finally, we also did a preliminary estimate of your 2025 itemized deductions. And although your state and local taxes paid are just over 111,000, the SALT deduction limit is $10,000. And so when we combine the deductible mortgage interest on the vacation home and the charitable contributions, your total itemized deductions are estimated at $25,500. Now, as we'll look into, this year could be a great year for you guys to itemize taxes if you're already not doing so. Given what we already know, it would be more advantageous for you to itemize versus taking the standard deduction. And then, just going forward, another recommendation that we had when it comes to the tax planning side of things. I know that both of you, well, just in general, you're both eligible to contribute up to $108,000 annually from your respective IRA accounts as qualified charitable distributions. And I'll refer to those as QCDs going forward. So this would make a combined total of 216,000. Now, for you could use this as a tax minimization strategy where you could contribute up to those $108,000, and that would not be treated as income. Now, one thing we want to be mindful of is as you're reaching required minimum distribution age, and that begins at 73, for most, the QCDs can be used to satisfy all or a portion of your RMD while excluding the distribution amounts from taxable income. So, this is a really great strategy if you're not in need of income and looking to reduce your taxable income because those RMDs are the IRS's way of getting taxes back from us. So, all of this money has grown tax free or tax deferred. And this is their way for us to say, okay, now you need to start taking money out and paying the taxes that are due on those. Now, if you're not in need of income, the QCD is a really great tool because rather than those funds, being taxed as ordinary income for you, you can send them directly to a charity. And I know, John, you've already named the Salvation Army as the beneficiary of this retirement account. You can send it directly to the Salvation Army and just consider that as, not having been added to your income and therefore not adding to your taxable income. So this is a great strategy as you approach RMD age. We can evaluate what the QCD strategy might look like on a year-to-year basis. And then also just going forward, of course, we can look at different ways in which we can structure these accounts to be sent to different charitable organizations after your passing as well. Now, the last time we spoke, you both were interested in potentially funding 529 plans for your grandchildren. One thing to consider, especially as we're looking at itemizing deductions and trying to reduce our taxable income as much as possible, is that you may actually elect to what's called superfund your contributions. And what this means is that you're combining 5 years worth of annual gift tax exclusions. And so in 2025, this would allow each of you to contribute up to $90,000 per grandchild, or $180,000 per grandchild as a married couple without using any of the lifetime gift and estate tax exemptions. So, while these contributions don't reduce your taxable income, they do reduce your taxable estate and allow your assets to grow tax free for qualified education expenses. If you do choose to do this, you'll just need to file IRS Form 709, and it will be need to be filed properly, electing the 5-year averaging treatment. And one thing to just keep in mind too with the 529 plans, and especially as we're looking at super funding or funding quite a bit more than potentially may be needed, depending on what education costs are at the time of college, is that if each grandchild does not use up the full 529 funds, you can always change the beneficiary of one plan if one grandchild needs more than another, or they can also roll over the remaining 529 plans into a Roth IRA account. And of course, for those, it's up to 5 years. And so for this year, that'd be up to $35,000 over a 5-year period. So that's a great strategy for, using those extra funds if they aren't needed. Do you have any questions on that? And I would also be happy to connect with your children too, and we can help get those 529 plans set up. That'd be a great strategy just going forward for us to help plan for an education standpoint and especially from a gifting standpoint on your end. This is a wonderful tool to do so. But I'd be happy to connect with your children as well. But nope, no questions? Okay. And if you do, of course, as I mentioned, feel free to review this afterwards. I know it's a lot of information, but you can always review and then feel free to reach out to us should any other questions arise in the process. Okay. So finally, we're looking at, we've broken down taxes, retirement, investment planning, but it really all comes down to the estate planning side of things. And we provided a property ownership spreadsheet. And so you'll see that we broke down each of the assets, how they are held, what would be, you know, what would go through probate, what would not, what would qualify for the maritable or the marriage exemption. And so you can see that fully here. And we also did it for each one of you and attached that one for review. So, your current estate planning situation, while neither of you have an estate large enough to trigger federal estate taxes, essential estate planning documents are not yet in place. And so I know that was a big concern for us last time and, one of your main goals. And so we just want to reiterate that the absence of these documents and any mistitling of assets could create a gap in planning for incapacity or death should either of you need it. And so these should be addressed promptly. But our first recommendation really is to just meet with an estate planning attorney to establish those essential documents and get those in the process. And so, for both of you, we would recommend establishing a durable power of attorney and then also healthcare proxies. Have you talked to either of your children to see if either would be interested in doing so, or is there, a child that you think might be more suited for that role? Okay, Eileen. Okay, great. Well, we'd be happy to bring her into any of these meetings as well if you're comfortable. And, once those documents are in place, please do feel free to send them our way so that we have a copy on file. Wonderful. Next, we would also recommend retitling the vacation home, the automobiles, the boat, and the inverted Jenny stamp from sole ownership from John to tenancy by the entirety. The reason being that this would avoid probate costs, and this would also allow the assets to transfer automatically to the surviving spouse upon the first spouse's death. And so this was consistent with your estate planning objectives and really just helps to make the process so much easier after one does pass. We've had clients and families where, they might not have thought so far in advance and then they come to us and it's a whole process of, making sure that we can get the right assets to the right place. But really, there's so much we can do ahead of time to help get that taken care of. And again, this is something that should continue to be revisited to make sure that we have everything in place should, if and when that scenario does happen. We also would recommend looking at transferring assets or, transferring appreciated assets to an irrevocable charitable remainder annuity trust. And so this would provide a fixed, predictable annual income stream for life while deferring the immediate capital gains taxes on the contributed assets, and then have the remaining amount go to your charity of choice. Now, if the Salvation Army is already your strategy for the retirement account, this could also be a potential strategy for some of our taxable accounts and taxable assets, for us to just be able to make sure that we have consistent income streams with a charity being the remainder interest there as well. So after you meet with an estate planning attorney, we can definitely further discuss if any trust structure might make sense. This was just one recommendation. We can also look at a bypass trust or a power of appointment trust. Both of these could help get, regular income streams, but then also give power to, whichever remaining spouse there is or whoever the beneficiary is to appoint, different powers on the trust. And so this is something that we can further discuss too as we need. So, when we're looking at what that might look like, just in terms of implementation, the appointment with the estate planning attorney is really what's going to be needed to complete these objectives and should be made as soon as possible. We would estimate that the costs for implementing these recommendations, including changing the property titles, the attorney fees, all of that would usually come in, about $10,000 or so. That's what we typically see. But again, a small price to pay for assets to be transferred correctly and without the stress after passing as well. So we're happy to help in that process. And this, with a strong cash position, should be able to be taken care of fairly quickly whenever you are able to get that appointment scheduled. Now, we reviewed a lot, but I really want to distill it down to a few key action items. So, we did identify a handful of strengths as well as weaknesses in our current plans. And these first five recommendations are really helping us to align with those priorities that you mentioned and then improve your financial position to reduce those estate and gift tax liabilities as our main priority. Now, of course, our objectives will change and shift as you get older and as, things change, but this is, our current action plan and where we would start. So first, of course, as I just mentioned, is visiting with the estate planning attorney as soon as possible. And so we just want to make sure that we can get the proper estate planning documents, possibly a trust, anything needed to plan for the death or incapacity of either of you two. Now, this was the first goal you identified, which is why we're making it as more of an immediate action and, our first recommended course of action going forward. These things can happen, on a turn of a dime, and we want to make sure that we're prepared when that scenario does happen. So during this visit with the estate planning, the second thing we wanted to put as an action item was the retitling of the vacation homes, the automobiles, the boat, and the Jenny stamp, just to avoid probate costs, as I mentioned, and then also just making sure that the transfer goes smoothly. Now, is it possible for you to set up an appointment with an estate planning attorney this week? Do you already have one? No? Okay. Well, we'll go ahead and provide, we do work with another office nearby, so I can provide a contact for you there if you're interested. And of course, if you already have one or you find a different estate planning attorney, we're happy to work with them on your behalf as well. Now, the next course of action, we wanted to look at purchasing a long-term care policy as outlined above, and then increasing the homeowner's insurance coverage on the primary residence. So remember that we want to increase this to at least 620,000 to ensure that adequate protection is there. And then we also want to look at purchasing an umbrella policy to fill in any of the gaps and making sure that if you do end up moving forward with purchasing that new car, that you do have adequate protection for that new vehicle as well. Now, this was the second goal you identified, so should be addressed quickly, but not, as important as the estate planning things, but definitely worth getting on the calendar. Now, I know you have an insurance agent that you've been working with. Are you able to get a consultation scheduled either this week or next? Okay, perfect. Great. Well, let us know once that's done, or if you have any questions along the way, happy to help there as well. And then finally, or I'm sorry, we have two recommendations left. The first one, going back to your stated goal of reducing your personal income tax, we could also consider making the qualified charitable distributions from your retirement accounts, and then again, contributing to those 529 education savings plans for the three grandchildren. Now, those can be state specific. I'm happy to provide a few, the ones that I use or, that some of my colleagues use just in general programs wise, but you should be able to if assets are held at Schwab. They have a great system for that as well. And then, we can also look at doing charitable distributions, once our assets are brought over here as well. And then finally, we did recommend diversifying your stock and bond portfolio. Our firm is happy to develop an investment allocation strategy for you that maximizes returns, minimizes taxes, and then is aligned with your risk tolerance and timeline. So, at our next meeting, we can go ahead and present our investment plan recommendations for you. And we would recommend, just to keep momentum going, sometimes these things can get stuck, but we would want to meet here in the next week or two. So, if you're able to, we can look at calendars. But if you want to be able to schedule your estate planning and then insurance consultations before then we can look at booking an appointment 2 weeks out once those are there. And then, of course, we can answer any questions based off of what the conversation is at that time, and then also help you retitle any assets with us as well, should you need to. Okay, any questions on what we went over? I know it was a lot and, a fully comprehensive review. So we'll again revisit in different stages and revisit these different parts as needed. But any questions so far? Okay, no, great. Well, if you do have any, definitely feel free to reach out in the meantime, and then we will just plan to meet you again in 2 weeks. Okay, perfect. Wonderful. Well, it was so nice meeting with you both and, looking forward to getting some of these action items done and we can continue to build on that financial plan. And, even in this next meeting, I know we briefly mentioned, but we really are in the business of helping generations and helping families along all different generations. And so if there is ever a time when you want to bring in your kids or your grandkids, we'd be happy to help just do some basic financial education and help, meeting people where they're at based off of their financial position so far. So definitely happy to help in any way that we can. But again, we just want to thank you both for your time today, and we look forward to meeting with you again soon. All right. Thank you. Have a wonderful afternoon. Bye, Mr. and Mrs. Gessler.